One of the biggest fears among retirees is running out of money in retirement and having to be dependent on other people. That anxiety has been increasing in today's low interest rate environment. So what is the answer?
The answer? Create your own pension. Amber, Kiplinger's Personal Finance did a great article on this in November of 2020. And that Kiplinger article points out that people who have guaranteed income from lifetime annuities actually are happier and live longer. In today's video, we're going to show you how to set up your own do-it-yourself pension for your retirement.
So traditional pensions are getting more and more rare. Companies are not offering pensions. So how does someone go about creating their own pension?
Well, Amber, you create your own pension by simply using a portion of your retirement funds to purchase a guaranteed lifetime income annuity. Amber, we've talked about these annuities a lot, and there are several reasons to love guaranteed income in retirement. We already mentioned one that the article mentioned, living longer and you're happier. But it also takes away that concern, that worry that you will run out of money and be dependent.
So we're talking about just using a portion of your retirement fund. So walk us through how we calculate how much to use and how do we know?
Well, Amber, the best source of funds to use for a lifetime income annuity in retirement are your tax-deferred accounts, your 401k, IRA, TSP, 403b, any of these tax-deferred plans, because the IRS forces you to take money out in retirement so they can tax it. So why not set up an income stream right from the get-go so you don't have to worry about every year calculating your required minimum distributions from all your accounts and taking out the proper amount. So those are the best accounts to use. As far as what amount to use, Amber, that depends on each individual situation. But economists, PhDs, even the United States government all recommend that you should purchase a lifetime income annuity that, along with your Social Security benefits and any other pension benefits you may have, will cover your basic monthly expenses in retirement.
Okay, so if we're talking about just using a portion of retirement funds to do that, what do we do with the rest?
Well, Amber, good question. So assume that you've got maybe $500,000 in your 401k, and you determine that you only need about $350,000 of that to purchase a lifetime income annuity. What you do is transfer the $350,000 to purchase that annuity. Now, that is not taxable in the year it occurs, okay? It would be an IRA annuity that would be taxable only each year that you receive the income. The income you receive each year is taxable. The other $150,000 in your 401k would still be invested for growth, maintaining that growth, trying to outpace inflation each year.
So basically, if you set up an income annuity, you have guaranteed income for life, whether you live to be 82, 92, or 102. You have this guaranteed income that you cannot outlive. So it's basically the exact opposite of a life insurance policy, right?
Right.
You're insuring against living longer than you can afford to live.
That's right. Now, Amber, you mentioned 102 years old. I was talking to our neighbor just yesterday, Easter Sunday. She had just had dinner with her 102-year-old grandmother. So I hope that her grandmother is still getting her pension payment or annuity payment. But Amber, another reason that annuities are so great, we recently did a video on this. The most recent research from Wall Street is showing that income annuities can actually increase your retirement income up to 29%. So not only do you have a guaranteed income for life, you might get more income than simply trying to draw down the money yourself.
Another benefit to creating your own pension this way is that actually if you happen to die before you have used the whole cash value of that annuity, you can pass it on to your beneficiaries. This is not something that can usually be done with a traditional pension.
No, traditional pensions will always give the option of leaving something to a spouse, but that usually is reduced benefit, right? 75% benefit, 50% benefit. An income annuity, however, Amber, can be set up to cover both spouses' lifetime and still have a benefit for beneficiaries if they should pass away before the cash value is used up. So for example, you could have a husband and wife that is say, we're going to put in $500,000 to me. We're going to each get a payout for the rest of our lives as long as either one is alive. But if we haven't used up that full amount, whatever is left will then pass to our beneficiaries after we're gone.
So if you would like to learn more about creating your own pension and you have questions about how much you would need to put in to generate the income that you need in retirement, you can click on the link in the description to schedule a 15-minute phone call with us to work with NewGen.
So you can go to workwithnewgen.com and you can tell us, do you need to have a certain amount each month? And how much will that take today to purchase that? Or do you have a certain lump sum right now and you're curious of how much income that might generate in retirement? So go to workwithnewgen.com because you can make the rest of your life the best of your life.
Plan now to retire happy.